Well, in this world where investors are getting more and more attuned to alternative opportunities, not just the old way of putting your money into bonds or giving it to an insurance broker who would then put it into shares perhaps, and maybe you make money, maybe you don't. Well, there are many opportunities that were previously the preserve of the 1% that are now available to everyone. And this area is called alternative assets. And we're talking today to Anil Govind, who's a veteran in this field. BizNews community know all about 12J. Well, he'll be telling us how those investments have been going. He is the director and co-founder of Innovate Alternative Assets and Solutions. Anil, lovely to be talking to you about this new asset class. I suppose it's not that new because we've known private equity's been around a long time. There've been alternative energy, which is, I suppose, not been around that long, venture capital, but it's kind of all embracing. Maybe you can give us your definition of what alternative assets actually define.
Yeah. Alec, maybe to start, what alternative asset is not, maybe is a good place to start. So, alternative assets generally is not listed assets, it's not bonds, and it's not cash. What it does include is, private equity, a bit of growth capital between venture capital and private equity, infrastructure assets like fiber, alternative energy, all of that. It has fixed debt, and generally it's unlisted, or the raise is done in an unlisted environment, and then can be on a stock exchange at the end, but the raise is done pre the listing. Yeah. So yeah, it has quite a wide. Even if you do classic cars, it will be sitting under alternative assets. So it's got a wide range of stuff, and businesses can be alternative asset space. So private equity is a big part of our business here.
Maybe just give us a little bit of your own background. You are a chartered accountant. You did your articles with KPMG. In fact, your co-founder at Innovate, Matthew Lee, is also a chartered accountant. We know that it's a great entree into business. If you can understand numbers or accounting, then you understand business. Is that what led you into this field, given that you do come from a family that's steeped in business?
Yeah, I think it started with a family that was in distribution in 1954. So kind of grew up in that environment. Distribution environment 1954 was pretty advanced for the Indian family. And from a young age, grew up in there. So I'm a little more entrepreneur and not less CA, but CA comes as an add-on to the entrepreneurship side. I love to find opportunities to give client returns. And in the family business, it honed a lot of skills, but I ran a CA practice. After a few years, we only did mid-cap clients, over 30 million turnover. And when the clients couldn't find returns in their business, we would find business opportunities and hedge funds, and stuff that was going quite well in the late 90s and early 2000s. And get them the return, which was more like, over 20% at times. Was a good period. I think I was fairly lucky also. And I think that's where it started. And after a 5-year break in Drakensberg, I found this is where my passion is. I love to help people grow their assets. And alternative assets are a very unique and interesting place to help you improve your returns. If you choose the right asset classes or the right businesses or the right segments that can give a client a return in a market like ours.
Due diligence must be key.
Yeah, no, that's our reputation at play. So our general due diligence process, it starts with pre-criteria, just to see if they meet some initial criteria to be in the mix of what we will look at in terms of full due diligence. But a typical DD process, I'm a CA for 30 years, pretty conservative by nature beside the entrepreneurial side. It's covering all aspects of the business, from financial to strategy and management and possibility of conflict, integrity of management, things like the viability of that the industry, that segment, going into the business, analytics, and seeing can that business be sustainable for 10, 20 years also, We look at long-term business, so we're not mavericks that are trying to get 30% per annum. Our target is more like 15% annualized, sometimes after tax, 12 to 15%, but generally we achieve around 15% on a mix of different opportunities. But due diligence is the heart of our business. We choose the wrong backing. It's quite a big landscape, and it's kind of done a little hush-hush. So, there's not a lot of listed information on opportunities. So, that's really the heart of our business. Then clients come based on us delivering it.
Anil, take us through 12J and your experience there. And I ask this because in the last 2 years of 12J, the many members of the BizNews tribe invested into the opportunities that we showed them. You've also been operating in that field. It's a pity that it's no longer available to be invested in. But what has your experience been there?
Yeah, I think in the 12J space, our success came from, firstly, we had objectivity and independence compared to a house trying to market a product. So from the early 2019s, I think, when the time we started there. But 2019 is when we really started pushing that area. When the government gives an incentive, it does help with the return because you get a return from the tax break and then you got the return from the investment case. And our view was to select 2 moderate risk opportunities, 2 moderate high opportunities. Some of them were diversified portfolios, and 2 high risk, which was more technology based. I think we're very successful. Our returns have been showing. The moderate high have been kind of hitting those 12 to 15% mark. The moderate risk has been around 7 to 8%, and on the high risk, generally around 20 to 30% is what we are getting from them. And that's a growth play, technology. So that mix of different opportunities and then linking to a client and say, hey, where would you like to fit in, or would you like a diversified view with maybe a major focus on the moderate high and a few punts on the high, and a client that was a bit older, we went a little bit more moderate to moderate high. So that is a really nice, that independence gave us options, which a normal house wouldn't be able to give it. And also when the house sells to you, the marketing to you, when we share with a client, it's more about, sharing opportunities in an independent way, and we don't have any alliance to any house. We do what's best for the client, and that's a big thing that we offer that many other direct private equity houses don't have. Because
they've got it.
Yeah, but a very, very successful part, Alec. I must say we're one of the big raisers in that space in the country.
It is interesting, the independence, because I guess anybody wants to know that you are putting them into a investment which is suiting them best rather than perhaps the company that you're working for. Is there a secondary market in 12J investments or 12J assets?
I think it's a matter of the asset class. So maybe just to unpack that a little, if you went with moderate risk, it's generally income plays with the capital being paid back, and they have either they're recovering the capital and the return on a monthly basis, some mechanism where already there's payback of capital. So automatically, I'm assuming that will be paid out at least in the 6th year. Obviously, it had a 5-year tie-in, right? 12J. When it comes to moderate high risk also, they generally the houses plan their exit. So on most occasions, expecting them to pay. Obviously, liquidity is always an issue. So if you talk about the infrastructure space, or you talk alternative energy, and you're talking about fiber, those assets are in demand. So there's greater secondary market. And when you talk about technology, we did 2 technology plays pretty substantially. And They're houses that have 7 or 8 opportunities that they're investing, from machine learning to school management to gym management and various areas where with a proper use case. And there the exit happens more when the house sells an opportunity one by one. It's not like you're going to get paid all at the end, and more the time frame is 6 to 8 years. So I think in private equity, and as institutions know, it's a longer play. The returns are better. They have a little bit more consistency because we have light of what we're saying in terms of a business or an opportunity or a house. And but liquidity can be a problem at times. So I think that's something, long as it's willable and can be transferred to the next party, that's a good start. But to answer your question is that there's greater secondary market in the moderate to moderate higher risk space and less on. In the end, those technology companies will sell to international companies that are there, and the cycle is more 6 to 8 years.
What about 12B? We're hearing so much, and for those people who don't understand all of this, there's a Section 12 in the Income Tax Act, and then there was 12J where you could get your money back, whatever you invested. Now 12B is a similar tax incentive opportunity, particularly, if I understand correctly, for renewable energy. But maybe you can take us through that. Do you deal in that space at all?
Yeah, no, it's another area. As we were leaders in the 12J space, so have built up a pretty decent high net worth space. So maybe just to talk about 12B. So we're already raising in that space. I think we raised pretty decent value already, close to 100 million in total for the last 2-3 months. And there's still new houses that are coming on in that space. So maybe to unpack a little bit about how it arrived. So 12B was always there from 2016, where they had an accelerated allowance, 50, 30, 20. If you're over 1 megawatt in terms of supply commissioning, and under 1 megawatt was 100% in the year of commissioning of the alternative energy, mainly in solar. And with all that interaction with private sector, and that government finally came to the party on the budget speech, February 2023, and they actually announced 125% deduction on the commission value, which is really interesting because alternative energy has a leverage component or a debt component. So if you put, let's say, 1.2 million rand in, and the house had 40% of the capital is coming from debt, then 1.2 million will be 60% coming from capital, and 800,000 will be debt. Then you get a deduction on the full 2 million rand times 125%. So the deduction is even more powerful than 12J. Really, one thing, Alec, I believe if government is doing something and they're in the soup, and in this case here, we really have a bad, energy issue right now. We're the best utility in the world, and really, if you look at where we are now, that was in 2001, by the way, best utility in the world. But our infrastructure is failing. Load shedding is becoming frustrating. So they had to make this change because to get the private sector fully engaged, to bring the big value up. Now there's no. 1 megawatt is only 10 million rand. How does a big house do alternative energy solution with a 10 million rand cap, upfront? So that if you do a 2 million rand example, you're getting 125% of that as a deduction, which means your saving in the personal side can be anything from 75% to 90%, depending on your tax rate. And on the company side can be from, instead of 27%, can be right up to over 50% from the tax saving alone. And then the yield side is typical to a bond yield to start, starting at 7-8%, and moving towards double digits by year 5, 6 going on. And the timeline is usually 10-15 years, that's the timeline. So it's a moderate risk asset class. So the investment case is moderate risk. So older client would be more keener on that than private equity.
And the tax benefit, of course, makes it doubly appealing. You also do look offshore, though. Where do you put your clients' money when you consider offshore alternative assets?
Yeah. So our main thing in offshore is we like to find bespoke assets. So I'll give you an example on the couple of sectors that we've been focusing on. We focused on property as an area, and we focus on private equity in the SME space. And there's a couple of other multi-asset examples. But let me take the property to unpack it a bit. So on the property side, we took an opportunity in the US, which is medical office buildings next to hospitals, which is a trend in the US. Based on that discovery type of model, US, I think there's a move of about 15% from hospitals to in office kind of procedures or day procedures. So that's a very nice play. The IRR is around 10%, 7% from the rental. The buildings are pretty well occupied, more like 80, 90%. Some of them are 100% occupied, triple net leases sometimes. And then you get another 3% or 15% when they sell the property. So you're getting a 10% after-tax return on a property asset class, as opposed to getting on a listed environment more like 4.4%. That's the actual average in the US for a property, medical property. And it's got demand, higher demand than normal property. As you saw in COVID, it showed up property, the typical commercial property and other stuff which had to close and had very disruptive time. But medical office buildings still continue. People still get sick no matter what the environment is. So, and then we're doing a property asset in the UK, and we believe in also currency diversification. That's in pounds, giving a 10% return if you want money paid out, and 12% return if you capitalize for 2 years and you get your capital with 24% return. And these guys have been going for 20 years. Basically, they do property for offtake. So I'm sharing the details because the devil's in the details. Like anybody can do property, but what we like about that is that offtake environment. You're building for listed retailers like McDonald's and Starbucks, and you're building for distribution warehouses where they're either listed or they're pretty sizable, and you're building for a company that's actually buying a property for rental. So at the end of a period of 2 years or 18 months or 3 years, you actually have an offtake, and that's good in an environment like UK where the inflation was very high and, all of that. So like, that's an example. And then private equity in Europe, we've been doing an opportunity there, focus on the SME sector. They're much more resilient than corporate houses overseas. I do find it very enticing. So just to give you an example, and then we also like direct private debt, which is much more exciting than the bond yields overseas until this year, which is more like sometimes negative or 2% on average. Yeah, I think now it's gone up a little bit more, but yeah, the thing is in the private environment we get very nice returns in the fixed debt environment. Internationally and locally, we are focused on the fixed debt with security, obviously.
So always looking for opportunities. What gets you up in the morning? A new opportunity?
Yeah, I think the starting point is that we want to help people, have choices when they retire. That's, for me, helping a client get to their goal is key. Like in South Africa, Alec, you've probably done tons of these interviews. So, 94% of people can't retire in South Africa. That's a stat. 6% of South Africans can retire. And for me, I think as a CE with 30 years experience, that's what I want to change. I want to change where people get into the better assets. They understand the value of allocation in alternative assets and what it can do for them. And we've achieved that, with our growth in the last 6 years, where clients, they achieve a double-digit return as a minimum. And that really makes a difference. You earn like 7% return, your money only doubles in like 9 years. And if you earn 15%, it doubles every 5 years. And, 12% is 6.5 years. And the multiple factor if you're going over 20 years, it's really totally substantial. So to answer your question, that's what wakes me up. And then I'm a I'm a typical technical. I love the due diligence space, and I really give our suppliers a bit of a tough times. I think they'll say that quite openly, I think, at times. But yeah, for us, we're not there to select anything. Just, we do it properly. Even if 95%, I think we had an opportunity earlier this year. We had 95%, but we still said no at the end because we still weren't comfortable about a couple of things. And for us, we're not desperate for any opportunities, no, with any fees. We focus on what is best, what is the best thematic that can give a client a return, and what is the best company. What's the best jockey? If you don't find the jockey, we continue looking. And because we have this abundance attitude, we also attract a lot of guys coming to us. Nowadays people knock on our door regularly because they know, I think we have a good reputation also.
Anil Govind is director and co-founder of Innovate, Alternative Assets and Solutions. I'm Alec Hogg from BizNews.com.